Hey everyone, welcome to the weekend edition of Markets Around the World. Happy New Year and Merry Christmas. I know I've not posting video for 2 weeks. Sorry about that. I was on vacation, enjoying the holidays. But now I'm back, and we've got so much to talk about. Stick around because I'll be sharing some big updates and insights about 2025. Welcome back, ladies and gentlemen, I'm K2, and today we'll dive into the latest market trends, key updates, and what to watch for in the weeks ahead. If you love the markets as much as we do, hit that subscribe button and let's jump in and get started with the top headlines. Santa Claus skipped Wall Street for the second year in a row, but stock market bulls might still have reasons to stay optimistic if January starts the year on a high note. This idea comes from a few seasonal indicators that tend to grab attention around this time of year. One of the most popular is the Santa Claus Rally, back in 1970. The rally focuses on the S&P 500's performance during the last 5 trading days of the year and the first 2 of the next. This year's period, running from December 24 to Friday, saw the index gain 1.3% on the final day, but it still ended the stretch down 0.53%. Leaving Santa's visit canceled. A Tesla Cybertruck exploded outside the Trump International Hotel in Las Vegas on Wednesday morning, killing 1 person and injuring several others nearby, local officials said. Authorities are investigating the incident as a possible terrorist attack, though no motive has been confirmed. The explosion came just hours after a driver flying an ISIS flag plowed a rented pickup truck into New Year's Eve revelers in New Orleans, killing at least 15 and injuring over 30 before being shot by police. Both vehicles were rented from the same company, Turo, according to Las Vegas Sheriff Kevin McMahill. We're starting the year with troubling crimes, and hopefully, it ends on a better note. This year is shaping up to be a volatile one for Tesla and Elon Musk. Shares of Ford and Rivian rose on Friday, as both automakers reported increases in EV sales. Rivian investors were particularly pleased to hear that a parts shortage affecting production is no longer an issue. General Motors reported a 50% jump in EV sales for 2024 and a 125% increase in the fourth quarter, contributing to a 4% overall sales growth for the year, reaching 2.7 million vehicles, its highest total since 2019. Ford announced record-breaking sales of electric, hybrid, and plug-in hybrid vehicles in 2024, up 38% to 285,291 units, outselling GM and Stellantis in EVs for the year. Total fourth quarter sales rose 9%, with overall 2024 sales up 4%. 2 Federal Reserve officials stated on Saturday that while progress has been made, the fight against inflation isn't over. However, they emphasized the importance of avoiding harm to the labor market. Governor Adriana Kugler and San Francisco Fed President Mary Daly highlighted the Fed's delicate balancing act as it slows the pace of rate cuts. Last year, the central bank reduced short-term rates by a full percentage point, bringing them to a range of 4.25% to 4.50%. Apple started the new year with iPhone discounts in China, highlighting its challenges in a key market. According to the China Academy of Information and Communications Technology, foreign smartphone shipments to China dropped 47.4% in November compared to the same period in 2023. This follows a 44.25% decline in October, marking the 4th consecutive month of decreasing shipments. Now, I want to share some important data and charts that you need to see before starting 2025. Stay with me. This is going to be interesting, and you won't want to miss it. Sticky inflation and a stable job market have lowered expectations for interest rate cuts. Unless economic growth slows significantly, we expect mortgage rates to remain high, slightly dropping to around 6% by the end of 2025. Bond markets have pushed 10-year yields higher due to stronger economic data. However, ongoing uncertainty around growth, inflation, and policy changes may lead to mortgage rate volatility next year. Over the past 6 months, the 10-year Treasury yield has fluctuated widely as markets assess the neutral Fed funds rate and navigate economic uncertainties. Existing home sales will remain near 30-year lows, but location matters. We forecast existing home sales to reach 4.25 million in 2025, a 4.8% increase from our expected 2024 sales pace of 4.06 million, but still down 20.3% compared to 2019. The anticipated rise in inventory will modestly boost sales next year. As of the end of November, the National Association of Realtors reported 1.37 million homes available for sale, up 19.1% from a year ago. However, with mortgage rates expected to remain above 6% in 2025, affordability issues and the lock-in effect will likely continue to hinder the recovery of existing home sales. Most mortgage holders are locked in with rates below 4%, and affordability is at its most constrained since the mid-1880s. As of September, 58% of Fannie Mae single-family loans had fixed rates under 4%, while only 14% had rates above 6%. Although the lock-in effect is expected to gradually diminish, the process will likely be slow. As previously mentioned, there is significant regional variation in available homes for sale, with some areas likely to see higher sales in 2025 compared to 2024. Markets with robust home building in recent years, such as many Sunbelt states, including Florida and Texas, and parts of the Mountain West and Pacific Northwest, have inventory levels at or above pre-pandemic norms, according to Realtor.com. In contrast, the Midwest and Northeast have considerably fewer homes available for sale compared to 2019. Overall, we expect inventory levels to continue gradually rising nationwide, with the Sunbelt maintaining looser inventories compared to the Northeast and Midwest. New home sales will remain a bright spot in the housing market, where they can be built. With limited existing home supply and strong demographic demand, we anticipate another solid year for new home sales in 2025. Through October 2024, new home sales averaged an annualized pace of 682,000, up from 595,000 from 2015 to 2019, and we expect this trend to continue. Despite elevated mortgage rates, home builders are offering incentives, like interest rate buydowns, and adjusting their offerings to include smaller, more affordable homes. The median sales price of new homes has approached that of existing homes, with a price premium averaging only 4% in 2024, compared to 28% from 2015 to 2019. New home sales vary significantly by region, with the South and Mountain West leading in construction due to favorable land and zoning conditions. Of the approximately 750,000 single-family housing permits issued year-to-date through October, 20% were in Houston, Dallas, Phoenix, Atlanta, and Charlotte. We expect significant home building activity to continue in the Sunbelt in 2025. National home price growth will decelerate. While limited inventory has supported robust home price growth, we expect a continued deceleration into 2025. We project year-over-year home price growth to be 3.6% in 2025, down from 5.8% in 2024. Although mortgage rates will remain a challenge for affordability, slowing home price appreciation could allow nominal wage growth to outpace home price growth for the first time since 2011, gradually improving homebuyer affordability. However, significant regional differences are expected. Current variations in for-sale inventories are leading to diverging home price trends. Among the FHFA's top 100 metros, 75 saw positive, seasonally adjusted quarter-over-quarter home price growth in both the second and third quarters of 2024, an atypically small share outside of the Great Financial Crisis and the third quarter of 2022, when prices declined nationally. We believe regions with greater inventory will likely experience weaker home price dynamics compared to the national average in 2025. Needless to say, construction and sales of residential buildings have come to a halt. Here's a chart showing the floor space started and sold. Starts have declined by approximately 12 billion square feet since their peak in 2021, and the situation is only getting worse. China is in urgent need of major restructuring. Dreams on hold. US mortgage applications hit 10-month low. Feeling the impact of soaring mortgage rates? You're not alone. Mortgage applications in the U.S. have dropped by 12.6% compared to last week, marking the steepest decline in 10 months. As rates approach 7%, many aspiring homebuyers are finding their dreams of home ownership increasingly out of reach. This significant drop underscores the challenges faced by those trying to enter the housing market amid rising borrowing costs. Big retail firms are getting even bigger. Amazon, Costco, and Walmart now account for a record 17% of total U.S. retail sales, up 6 percentage points since 2014. They have also contributed to approximately 57% of retail sales growth during this time. As a result, share prices for Amazon, Walmart, and Costco have soared by 1,025%, 332%, and 862% respectively since 2014. In 2024 alone, these stocks rallied 44%, 74%, and 40% respectively. Big retailers are dominating the market. Early January might see positive market sentiment, especially with the first trading days historically favoring gains. The middle of January, with FOMC minutes and options expiration, could introduce volatility or significant market moves. The end of January might conclude a typically strong period for the market, aligning with the best 3-month span ending. This chart is quite interesting. S&P 500 capital expenditures. It illustrates the cycles of capital expenditures among companies in the S&P 500 from 1998 to 2024, highlighting key events such as the dot-com bubble, 1999 to 2001, housing bubble, the years 2006 to 2008, shale revolution, 2013 to 2015, and the current AI frenzy, 2023 to 2024. The recent surge driven by AI investments is reaching historic highs, raising potential risks of a cyclical downturn similar to past bubbles. Since at least 1952, when comparable return data first became available, the S&P 500 has never dropped more than the 2.6% it lost from Christmas to year-end, according to data compiled by Bespoke Investment Group. This closing decline marks only the 12th time the benchmark index has fallen by more than 1% in that period, and represents the longest streak of losses to close a year since 1966, per Bloomberg data. S&P 500 forecasts by firm. The median forecast for the S&P 500 suggests a potential increase of plus 12% above current prices, reflecting a generally optimistic outlook among analysts and investment firms. This positive sentiment is driven by various factors, including expectations of economic recovery, strong corporate earnings, and favorable market conditions. As investors anticipate growth and resilience in the market, optimism is running high this year, with many hoping for a robust performance in the S&P 500. Analysts are closely monitoring key indicators that could impact this forecast, such as inflation trends, interest rates, and consumer spending, as they evaluate the potential for continued upward momentum in the index. The Fear and Greed Index has dropped back to the fear level, sitting at 32 as we step into 2025. With market sentiment shifting and uncertainty looming, this year is shaping up to be an interesting one for stock markets. Investors will likely face heightened volatility as they navigate key economic developments, corporate earnings, and global events. Stay tuned. 2025 could be a pivotal year for market trends and opportunities. Now let's end this video by look at key events for upcoming week. Monday, January 6th, SP Global Services, PMI. Tuesday, January 7th, ISM Non-Manufacturing PMI. December, ISM Non-Manufacturing Prices, December. JOLTS Job Openings, November. Wednesday, January 8th, ADP Non-Farm Employment Change, December. Crude oil inventories, 10-year note. Auction, FOMC meeting minutes, released at 11 a.m. Thursday, January 9, holiday, United States. National Day, initial jobless. Claims 30-year bond auction. Friday, January. 10 average hourly earnings, month over month. December. Non-farm payrolls, December. Unemployment rate, December. All right, folks, that's a wrap for this video. If you enjoyed the content, don't forget to like and subscribe. Got questions or thoughts? Drop them in the comments and I'll respond as soon as possible. Thanks for watching, and I'll catch you in the next one. Take care.